So welcome back everyone to another Forex analysis video. So the first pair we have today is the Australian dollar versus the Swiss franc. If we switch down to the 2 hours time frame, we can see that it is in a consolidation pattern between medium to broad range. So if we can spot right here, we can see there is a trend line going on. So to plan our trades, we can plan them like accordingly. So for a bullish trade, we can go long as soon as there is a candle closure above this trend line, and our stop loss should be below the last bearish candle, and our target should be this successive swing highs. The ultimate target should be around the upper ranges. Also, it might give a breakout since the range has been tested multiple times. On the other hand, for a bearish trade, we can go short as soon as there is a candle closure below this range, and our stop loss should be above this last swing high, and our targets should be the successive swing lows. This should be our targets, and our targets are projecting at a risk to reward ratio of at least 1:1.5, and the ultimate target is around 1:3.5, you can say. So the next pair we have today is the Australian dollar versus the Japanese yen. It has been on a consolidation to bearish consolidation phase, we can say, and currently it has just taken resistance from the upper ranges and on its way towards the lower range. So it is also forming kind of a rising wedge pattern, which is expected to give a breakdown. But when the market opens tomorrow, if we see that the prices are going trading near this range, and then it takes a rejection from the upper range of this wedge pattern, and we can check on a lower time frame if there is a formation of any kind of like a double top pattern or any kind of candlestick pattern, then we can go short right here. And for a very safe stop loss, we can put our stop loss above this range, and our first target should be this around this point, and then our successive target should be the swing lows. We can ignore the swing lows, or we can also take this as a target. That will only increase our risk to reward ratio. And also the real target should be around this swing low, and then this, and the ultimate target should be this major range, the bottom of the range. Also, on the other hand, if the market opens near flat or gap down, we can start shorting as soon as the price starts trading below this range, and we can add more lots when the price starts trading below this price point. This is around 93.098, and then our first target should be this swing low, and accordingly our ultimate target should be this the ultimate range low. It will give us around 1:9 risk to reward ratio, but we can always start booking profits from 1:1.5, and then we should always trail. So the next pair we have today is the euro versus the New Zealand dollar. It is showing us a very classic reverse head and shoulder pattern. So head and shoulder patterns are known for a very strong reversal signs, and since this pair has been on a downtrend, it can actually turn this trend around and go towards a bullish trend right now. So the targets for a head and shoulder pattern is calculated from the distance between the head to the neckline. So it is around 365 pips, but for safety we can take it for around like 300 pips. So I have considered around 310 pips as our target. So as soon as the market opens tomorrow and the price starts trading above this price line, we can start to we can start to go long, and we can take a very tight stop loss right here, but I would recommend the stop loss to be kept at this point at near around 1.61784, and our first target should directly be this line. Also, we can start booking profit as soon as the price starts to hit the 1:1.5 range. So, and ultimately there might be a breakout from this point, and then we can see larger targets around this range as well. So the last pair we have today is the New Zealand dollar versus the Japanese yen. It is showing a very complex price action actually. So we can see that the price was respecting these levels, and then it gave a breakdown, but there was no price action and it gave a V-shaped recovery. After that, it tried to break again, but again it showed a V-shaped recovery to us. Then the price moved up actually. Then it fell vigorously, then made a lower high, it fell again made a lower high, and currently it's near the range. So we can also see that there is a kind of very unconventional double top pattern right here. It is just formed, and we should only actually plan for the bearish side, but if someone's willing to risk, then they can also plan for the bullish side as well. So for the bullish part, we can see like if there is a candle formation, like we can see that it was a bearish marabuzu, then kind of a, you can say kind of a doji pattern. And then if we spot any kind of bullish candle like a bullish marabuzu right here, we can go long with our stop loss just below this point. It will be a very tight stop loss actually, and our first target should directly be this swing high, and then the successive swing highs as our target, until this should be the last, this should be, you know, the ultimate target for the bullish trade. That will be around 1:7 risk to reward ratio. But for the bearish side, as soon as the market starts trading below this last swing, I'm sorry, the range low, we can short, and our stop loss should be above this last bullish bearish candle, and our target should be this successive swing lows. This should be our targets. So the first target is giving us around 1:3 risk to reward ratio. The next will give us around 1:6.5, and the ultimate target will give us around 1:9 risk to reward ratio. So that would be all for today's video. Thank you. Stay subscribed.